In the last video, we learned that revenue is the money coming into a business. But here's the important part. Just because a business earns a lot of revenue doesn't mean it keeps a lot of money. Why? Because businesses also spend money to operate, and those costs are called expenses. Now let's define expenses in accounting terms. Expenses are outflows of economic benefits incurred in the ordinary activities of a business. As mentioned, it is an outflow of economic benefits. This simply means money or resources leaving the business during its normal operations. Unlike revenue, which brings money into the business, expenses take value out of the business. And these outflows happen because businesses need to operate and generate revenue. Now let's look at the most common types of expenses. First is rent. If a business pays for office space or a shop, that payment is an expense. Salaries. Money paid to employees is also an expense because employees help the business operate. Utilities, like electricity, water, and internet. All of these are operating costs. Advertising. If a business pays for marketing or social media ads, that is an expense. Supplies. Materials and supplies used in the business are also expenses. So now we understand what expenses are. Why are they so important? As we discussed, businesses pay for things like rent, salaries, utilities, advertising, and supplies. These expenses are necessary because they help the business operate and generate revenue. But there's an important trade-off. Even though expenses help the business run, they also reduce the amount of profit the business keeps. For example, if a business earns $1,000 but spent $900 on expenses, only $100 remains as profit. So businesses must manage expenses carefully. And this leads us to one of the most important formulas in accounting. This formula connects this video with my video on revenue together, because revenues minus expenses is profit. Revenue is basically the money coming in, and expenses is money going out. Hence, profit is what remains. Let's try a quick example together. If revenues are $600, expenses are $400, what will be the profit? The profit will be $200, which is 600 minus 400. But what happens if expenses become too high? Now this is very important. If expenses are greater than revenue, the business makes a loss. This means the business is spending more than it earns. Let's quickly compare profit and loss. Here's the simple rule. If revenue is higher than expenses, you make a profit. But if expenses are higher than revenue, you make a loss. This is one of the most important ideas in accounting. Now let's see if you understand the concept. If revenues are $700 and expenses are $900, would there be a profit or loss? This would result in a loss of $200 because expenses are higher than revenue. Losses are often written in parentheses like this, and in accounting, the parenthesis means it's a negative result. Now let's bring everything together. First, expenses are simply money going out of the business. These are the costs needed to run the business, like rent, salaries, and utilities. Now here's the key idea. Expenses reduce profit. So the more a business spends, the less it keeps. Now we can define the outcome in simple terms. If revenue is higher than expenses, the business makes a profit. And if expenses are higher than revenue, the business makes a loss. So everything comes down to the simple relationship between what comes in and what goes out. Now that you understand expenses, the next step is learning how to tell accounting terms apart. Because in accounting, some terms can sound similar, but they mean very different things, like assets versus expenses or revenue versus profit. In the next video, we'll break down the most commonly confused accounting terms. And if you're following this basic accounting series, make sure to subscribe so you don't miss the next lessons.